Welcome back to the deep dive. And today we're looking at something that has been quietly building under the surface of the market. It's not a headline, it's not something you'll see plastered across CoinDesk or Twitter, and it's not a narrative pushed by the big-name influencers. It's something far more subtle, but far more important, because markets rarely explode out of nowhere. They build pressure, they shift weight, they rotate, and if you understand those rotations early, that's where you get the asymmetric opportunities. So today we're looking at what's happening in the mid-cap and altcoin space, what the data actually shows, what whales have been doing behind the scenes, and what this could mean going into December, January, and beyond. What we're seeing right now is a textbook example of what analysts call a latent rotation phase. It's not the full-blown altcoin mania you'd expect at the peak of a cycle. It's not even the pre-hype phase where retail starts creeping back in. What we're seeing is a type of quiet accumulation that tends to happen when the majors, especially Bitcoin and Ethereum, hit a short-term equilibrium. Analysts like Matthew Hyland have pointed out repeatedly that when Bitcoin stabilizes, even if it's a bit choppy, it creates breathing room underneath for capital to rotate into the mid-caps. Hyland said recently, "People underestimate how often rotations begin when the market looks boring." And that's exactly the environment we've been in for weeks. The surface looks flat, but the underlying flows are not. Take the recent performance of coins like Hyperliquid, Kaspa, and Monad. Out of nowhere, these chains started posting double-digit 24-hour gains. And this isn't just some random pump-and-dump behavior. The order books show deep buying, aggressive long positioning, and most importantly, consistent whale wallets adding to their stacks on-chain. Kaspa saw a jump in whale transactions over $100,000 that was more than triple what it was the previous week. That's not noise. That's not retail. That's structural accumulation. And when you pair that with what's happening to Bitcoin dominance, the picture becomes even clearer. Bitcoin dominance hasn't broken higher, despite being in a consolidation range. In previous cycles, when BTC dominance stalls after a strong run, it has almost always signaled a period where traders begin to look for higher beta returns, which are almost always found in the mid-caps, not the micro-caps. Micro-caps are later. They're the mania phase. But mid-caps are the first to benefit from rotation, because they're big enough to be seen as safe enough, yet small enough to offer meaningful upside. Another analyst, TED Talks Macro, noted this week that liquidity pockets in altcoin order books have been filling far earlier in the cycle than expected, suggesting aggressive positioning by funds that want exposure before retail notices the shift. That's an important point. When funds take early positions, they don't do it to flip tokens in 24 hours. They do it because they're setting up for a 3-month narrative that they believe is coming. And the narrative that seems to be forming, whether intentionally or naturally, is that the altcoin market has absorbed enough of the summer and autumn selling pressure to start its next phase. But what's actually causing this rotation? It's not hype. It's not some artificial trigger. It's structural. Bitcoin's rally this year, combined with the ETF inflows earlier in the quarter, has created something very rare, a stabilization period at a high level. When Bitcoin stops being volatile and sits in a relatively consistent range, traders start looking elsewhere for movement. Sideways Bitcoin is historically one of the most reliable altcoin catalysts. It's not necessarily explosive for altcoins, but it lights the fuse. Let's talk about stablecoins for a moment because this is a crucial part of the picture. Stablecoin liquidity is still far lower than in previous bull markets, but what matters isn't the total supply. It's the direction of flow. Binance USD outflows have nearly stopped. USDT on exchanges has risen slightly for the 3rd week in a row. USDC has finally stabilized after months of bleeding. This is exactly what you want to see before a rotation. You don't get a rotation with no dry powder. You get it when stablecoin inflows start pointing upward, even modestly. And that is what's happening right now. But the biggest confirmation that rotation might already be underway is in exchange positioning. Derivatives data shows funding rates on mid-caps rising faster than on Bitcoin, which means traders are paying more to stay long altcoins than they are to stay long BTC. Usually, that's a top signal, but only when it happens late in the cycle. Think of it this way. Bitcoin's job early in a cycle is to drag liquidity back into the market. Once liquidity is in, traders look for higher returns. That's where altcoins come in. And right now, the data shows traders beginning to look. You're seeing the first stage before the first wave of hype. And historically, this is where some of the biggest multi-X opportunities live. Now let's bring Ethereum into this, because Ethereum is the key that unlocks the rotation. Ethereum has underperformed Bitcoin for weeks, but what's interesting is that the spread between it and BTC volatility has narrowed dramatically. When Ethereum volatility tightens like this, it usually precedes a move. It doesn't guarantee the move will be to the upside, but in the context of current market conditions, with risk appetite climbing and stablecoin inflows improving, the probability leans positive, and when it moves, the rest of the altcoin market tends to move behind it. We are going to take a short break here for our sponsors. Stay with us.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
What can 160 years of experience teach you about the future? When it comes to protecting what matters, Pacific Life provides life insurance, retirement income, and employee benefits for people and businesses building a more confident tomorrow. Strategies rooted in strength and backed by experience. Ask a financial professional how Pacific Life can help you today. Pacific Life Insurance Company, Omaha, Nebraska, and in New York. Pacific Life and Annuity, Phoenix, Arizona.
Okay, let's get back to it. Another thing analysts pointed out this week is that gas fees have dropped significantly. This might sound unrelated, but historically, low gas environments encourage increased activity on DEXs, smaller swaps, and higher transaction volume. And higher transaction volume, especially on-chain, is a direct signal of early-stage interest in altcoins. People don't pay $100 gas to ape into a mid-cap token, but they will absolutely pay $3 gas. Low fees are a gift to early-cycle altcoin markets. But we can't talk about altcoin rotation without talking about the psychology behind it. Because markets are, more than anything, psychological environments. Traders have been traumatized by 2 years of downside and sideways action. They've been conditioned to be hyper-defensive, they're cautious, they're slow, and they don't want to be early on anything. And that is exactly the kind of environment where early rotations slip under the radar. It's not loud enough to trigger fear of missing out, but it's meaningful enough to show the market is preparing for the next chapter. Now, combine that with holiday liquidity, especially around Thanksgiving in the US, which always causes weird, thin volume moves. This creates ideal conditions for altcoins to outperform. It doesn't mean they're heading into a mania phase next week, but it does mean that you get exaggerated moves when small amounts of money enter or leave mid-cap order books. And exaggerated moves, especially upward, draw attention. That's how rotation starts. When you dig deeper into what's happening beneath the price action, one of the most compelling signals isn't coming from exchanges at all. It's coming from wallets that haven't moved in months. Some of the largest mid-cap holders, especially in chains like Kaspa, Optimism, Monad, Kava, and Fetch, have begun showing quiet but consistent accumulation patterns. Not huge transactions, not the kind of splashy whale movements that pump crypto Twitter into hysteria, but strategic additions, the kind that come from entities who care more about positioning than hype. This is the type of accumulation that analysts like Ali Martinez highlight as smart money behavior. And he said earlier this week, mid-cap accumulation tends to lead sentiment by 2 to 4 weeks. That is not something you ignore. It's also worth talking about developer activity because it's an underrated rotation indicator. In every cycle, the coins that lead the early altcoin runs tend to be the ones with consistent development during the bear market. Right now, GitHub activity for networks like Injective, Mantle, Kaspa, and Filecoin has quietly increased even while prices were suppressed. And developer engagement is not retail hype. Developers don't write code based on price. They write based on conviction and the long-term roadmap. When development increases while prices are stagnant, it often means the fundamentals are improving even faster than the market realizes. In previous cycles, Early developer surges also preceded the strongest altcoin rallies by anywhere from 6 to 12 weeks. But let's look at liquidity pools for a second, because this is where the real narrative flips. If you compare the size of liquidity on decentralized exchanges today versus 6 months ago, several mid-caps have actually increased their pool depths. That's very rare in a flat market. Normally, liquidity dries up during uncertainty. But this time, liquidity is being front-loaded, which suggests market makers are preparing for increased volatility. Market makers don't waste liquidity. They deploy it where they expect action. And right now, they're planting it in the altcoin sector. Another analyst, Noel Atchison, who has been one of the most consistent voices on institutional behavior, said something important this week. Funds operate quarters ahead, not days ahead. That's crucial, because if funds want mid-cap exposure in Q1 or Q2 of next year, they begin taking positions now, during a period of low competition. They don't chase candles. They build slowly, unnoticed. And when you look at some of the fund flows into altcoin ETFs overseas, especially in Europe and parts of Asia, you can see early signs of structured positioning. It's not mania. It's preparation. Let's be honest here. Altcoin rotations are not driven by retail in the early stage. They're driven by structural traders who see the majors consolidating and decide that risk is finally worth taking again. And when those early movers come into the market, they don't just buy one coin. They create a basket, exposure to infrastructure coins, scaling solutions, layer 2s, privacy projects, and emergent chains. That basket effect causes clusters of coins to move together, which is exactly what we've seen this week. It's not a coincidence that multiple unrelated mid-caps all pumped within the same window. That's rotation behavior. But it's also important to break the myth that altcoin rotations only happen during strong Bitcoin performance. The truth is that rotations begin in boring markets. Look at 2016. Look at 2020. Bitcoin went sideways for weeks. Everyone thought the market was dead. And during that time, altcoins quietly built momentum underneath the surface. Then later, when Bitcoin broke resistance, altcoins exploded behind it. This isn't a bull trap. It's the precursor to momentum. What we're seeing right now mirrors the early stages of those movements. Bitcoin is doing just enough to keep traders engaged, but not enough to dominate the entire market's attention. Ethereum is stable. Stablecoins are slowly returning to exchanges. Liquidity is sitting on the sidelines but beginning to drip back in. Whales are moving in a coordinated, patient pattern. Everything here matches the behavioral signature of the beginning of a rotation. And one thing that doesn't get talked about enough is the psychological exhaustion of fear. Fear has a lifespan. People can only be scared for so long before they stop reacting emotionally. After 2 years of bearish sentiment, most traders are numb. That numbness actually lowers selling pressure. When sellers are exhausted, markets bottom, and rotations usually begin. You're seeing that right now with altcoins. Nobody is panic selling mid-caps anymore. They already sold months ago. What's left are holders and quiet buyers. Before going further, a reminder. If you're rotating into mid-caps, if you're holding assets long-term, or if you just want to avoid the exchange risks that come with volatile altcoin runs, get your crypto into cold storage. I use Ledger personally to keep assets off exchanges and protected. Link is in the description. So when you put all of this together, you're not looking at hopium. You're not looking at some influencer narrative. You're not looking at hype. You're looking at the data. You're looking at the behavior. You're looking at the structure. And the structure is telling you something simple and powerful. The conditions for a mid-cap rotation are not forming. They're already here. They're early, they're quiet, and they're easy to miss unless you know what you're looking for. But they're here. This moment in the market is the definition of early-stage opportunity. Not guaranteed, not risk-free, but structurally, historically, and behaviorally aligned with the beginning of something bigger. The kind of moment where the market breathes in before it roars out. Drop your thoughts in the comments, smash like, follow, and as always, we will see you at the top.